Hey, it's Nancy from Nancy Chu Homes at Keller Williams and J Metro Group. Today, we're going to start off with a couple of definitions. The first one is securitization. This is when lenders take loans and they sort of pool them together and they resell them on the secondary market as interest-bearing securities. Okay, so mortgage-backed securities are the prime example of this, and the secondary mortgage market kind of basically fuels the entire mortgage process in some ways. I'll give you an example. So let's say, for instance, you get a mortgage through NJ Lenders, and then after a little bit, you realize that they've sold the loan, you get a letter in the mail, and then they've sold it to Chase, and Chase becomes your new servicer. This happens all the time, and the terms of that loan has to remain the same, but that would be the secondary mortgage market, your loan being repackaged and sold, okay? And then that money comes back into the primary lender. Anyway, we'll go over that a little bit further, okay? Securitizations are down. What I thought I'd share that with you is, in other words, the secondary market is down, especially on like that private side right now. The investor base, the non-QM, which is the non-qualifying mortgages, the expanded credit mortgages, there's very little secondary market for those right now. The feds have been pulling back on buying mortgage-backed securities. When rates go up, every time you issue a new bond, it sort of immediately goes underwater, right? So investors are looking for a higher amount for their mortgage-backed security bonds, right? Because they keep thinking, well, there's going to be an even higher one coming down the pike. So rates, we think, are going to be moderating in the back half of 2023, possibly even a little bit sooner, into the low fives, all right? And recovery, historically with the Fed, all right, what you'll see we hit the peak of the rates, right? And then it still takes another lag time of about 4 or 5 months of a delay before after the peak, before you see actual recovery and you see the rates actually coming down and you see the lowering of that benchmark rate, right? That's the thing the Fed's been moving up. So conservative expectations for next year, like I said before, you may remember, tempered optimism. Now, don't forget, we mentioned before that lending in 2022 was down by 35%. Okay, so that means that we lent almost a third less mortgages we did in 2022 than we did in 2021. Okay, which means that there's been very little to securitize. All right, very little to hit the secondary market. Now, the primary market feeds into that secondary market, right? And the secondary market sort of recycles that money and puts it back into the primary market. It's a really big deal. That's how it works. If there's nothing feeding back from the secondary to the primary, then we're going to have some issues because who's got money to lend? Now, we do think that there's going to be a mini, what we call sort of a mini refi boom. Maybe I shouldn't call it a boom, but a mini refi like bubble, burp, because a lot of folks who, got their loans over 6%, between like 6 and 7+%, they're going to want to refi as soon as that interest rate, sort of drops down to that low 5 number that we're expecting. Now, there's something that kind of balances or could be a challenge to this, and that is we are seeing in some parts of the country housing value slide. All right. But what it's really doing is really just giving back a lot of that crazy pandemic appreciation that happened. But that may affect some refis, and it could be regional. So for instance, if you bought a house in Portland, Oregon, you might have seen in the last back half of the year, you might have seen your house prices slide by 9%, right? But let's keep it in perspective. You bought the house 5 years ago, and during the pandemic, it went up by 45%. So you might have lost 9% of that, but it's still a crazy amount of appreciation to have gotten from a house that you bought just 5 years ago. Now, there are certainly other places like Austin, for instance, or maybe Cincinnati, Idaho, parts like that where you're seeing, especially, I would say, sort of tertiary markets, you're definitely seeing a little more value loss there because their growth was so kind of unexpectedly crazy, that you're kind of seeing that temper down quickly. While those areas, sort of like us here in Northern New Jersey, where we have extreme proximity to a primary market, we might see a little less house value slide just because we have an inventory problem. Okay. So this is probably more of a regional issue, and we'll have to watch it as we go. And plus, I think there's going to be more potential refi value issues with anything that's an FHA product versus like if it's a Fannie or Freddie backed mortgage, because they usually have more equity in the home in the first place. So they can stand a little bit of price value movement. Um, Listen, the first half of 2022 was amazing, but the second half of 2022, man, we had mortgage backed security numbers like 2016. It was like, all right. I mean, lenders are postponing securitization moves because they just don't feel like getting hit, smacked so hard in the face, So listen, if you can't securitize, then you gotta keep and service that loan. Okay. And if you can't recycle that money through the mortgage backed securities, then the mortgage lenders may have to go to other resources for money. So, for instance, they might end up going to warehouse lending. Warehouse lending, by definition, it's almost like a line of credit for mortgage originators, all right, for loan originators. They might have to go to warehouse lending, but those interest rates aren't great, and they're certainly higher than the mortgages that they're currently holding and servicing. So that means more money out than in, all right? I don't know. This is all going to be really interesting because my take on this is that many of them are just going to kind of give up and package the loans anyway, even if they're doing it at a loss, because they just need the liquidity to service their loan side, service their primary loan side. And they may do it at a loss on their secondary mortgage side just because, especially if they have not, maintained adequate reserves. All right, guys. So what does all this mean? It means that, we're going to pay a little more careful attention to the mortgage companies that we're receiving offers from, that are servicing the clients that are coming through and making offers on our properties. I do think that, if a lot of the smaller mortgage companies have less access to money, then they won't be able to lend, and we might see some shutterings. As a matter of fact, some closings. As a matter of fact, next week we'll talk a little bit about a very interesting situation. But what I was going to say is I have an example of this, which is a few years ago, almost a decade ago, I had a lovely client who was buying a house in West Orange. She's amazing. And we got halfway through the process, and all of a sudden her lender went dark, like just went dark on us, and we could not figure out what was going on. She was panicking. I'm panicking. The selling side is panicking. And we didn't find out until it officially was announced that mortgage company had closed its doors. They just closed their doors and just stopped everything they were doing. And we were in the middle of the mortgage process. We had to, thank God we found out. And thank God the seller was willing to sort of wait it out with us. We scrambled and got her into a new mortgage quickly and had to sort of resubmit all the paperwork and start all over again. We had to do a new appraisal, everything. All the pieces that she'd paid for before, we had to do over again. So yeah, we're going to be really careful and do our due diligence on every single mortgage pre-approval that comes through, because I'm not letting that happen again. But as you know, this is the kind of crazy market and where things can happen. All right. If you have any questions, you are welcome to give us a buzz. 917-992-3098 is my cell phone. And I look forward to speaking to you guys next week. Have a wonderful, happy January.